If you think understanding the structure is enough, you're only seeing the surface. Because in serious investing, it's not just about how a deal is set up, it's about how it is controlled, monitored, and protected over time. In the last video, we covered the foundation of the corporate structure. Now, we move into an intermediate level, going one step deeper into what really matters when larger capital is involved. Let's get into it. One, how are SPVs structured for each project? At GHL India Asset, each project is executed through a dedicated special purpose vehicle, SPV, incorporated as a private limited company under the Companies Act 2013. The SPV structure is designed with complete financial and legal segregation. Structure breakdown. 1. Separate legal entity. Each SPV is formed only for one project. 2. Investor funding. Capital is raised via secured NCDs issued by that SPV. 3. Asset ownership. The property is acquired in the SPV's name. 4. Security creation. Property is mortgaged in favor of the debenture trustee. 5. Charge registration. Registered with MCA for legal enforceability. Control plus protection layer. 1. Promoter manages execution. 2. Debenture trustee holds security on behalf of investors. 3. Independent oversight ensures compliance. You're not exposed to the company. You're secured against a specific asset inside a legally structured SPV. Even if another project fails, your investment is ring-fenced within that SPV. 2. What is the relationship between the parent company and SPVs? GHL India Asset operates as the originator and manager of projects, while each project is executed through a separate SPV, special purpose vehicle. There is no layered holding or parent subsidiary structure. Instead, how the structure works. 1. GHL identifies, structures, and manages the investment. 2. A new SPV is created for each project. 3. The SPV raises funds via secured NCDs, buys and owns the property. He holds all project level cash flows. 4. GHL acts as the execution and management platform, not as a holding company. Our model is a deal-by-deal SPV structure rather than a pooled holding structure, ensuring direct asset linkage for investors. No layers, no confusion. Your investment directly sits in the project entity. 3. Are SPVs independently audited or consolidated under the company? Each SPV is a separate private limited company, so it maintains its own books of accounts and undergoes independent statutory audit as required under the Companies Act 2013. What this means in practice. 1. Independent accounting. Every SPV tracks its own income, expenses, and cash flows. 2. Separate audit. Financial statements are audited at the SPV level. 3. Project level visibility. Investors can assess the performance of a specific project, not a blended portfolio. On consolidation. Since GHL operates as an originator manager, not a holding company with consolidated subsidiaries. 1. SPVs are not presented as a single pooled financial entity to investors. 2. The focus is on project-wise transparency rather than consolidated reporting. You are not seeing blended numbers. You are seeing project-level truth. Audit reports and financials can be shared with investors as part of transparency and reporting. 4. Who appoints the debenture trustee? The debenture trustee is appointed by the issuing entity, the SPV, at the time of issuing secured NCDs in compliance with the Companies Act 2013, specifically provisions related to debenture issuance. How it works. 1. The SPV's issuer of NCDs formally appoints the trustee. 2. The appointment is documented through a debenture trust deed. 3. The trustee acts independently on behalf of investors, not the company. Role of the trustee. 1. Holds securities, mortgages, charge over the property. 2. Monitors compliance with debenture terms. 3. Acts in case of default to protect investor interests. All security is created in favor of the trustee, who holds it on behalf of all debenture holders. The trustee is your legal guardian, not the company's representative. 5. How is investor protection ensured at the corporate level? At GHL India Asset, investor protection is built through a multi-layered structure combining legal safeguards, asset backing, and operational discipline, not just promises. Based on our business model, protection is ensured at 4 levels. 1. Structural protection SPV model. Each project is executed through a separate SPV. Funds are ring-fenced for that project only. No cross-liability between projects. It ensures your investment is isolated and protected from other deals. 2. Asset-backed security. Investments are made via secured NCDs, underlying properties, acquired in SPV name, mortgaged in favor of debenture trustee, registered with MCA. Security cover maintained at approx 1.1x 1.5x of investment. It ensures your capital is backed by a tangible asset. 3. Independent oversight. A debenture trustee is appointed as per the Companies Act. Trustee holds security on behalf of investors. Monitors compliance. Acts in case of default. It ensures that there is an independent authority protecting investors. 4. Process and due diligence control. Legal verification of property. Government aligned valuation. Pistole-based investment analysis. Market cycle-based structured acquisition exit strategy. It ensures risk is minimized before investment itself. Protection is built into the structure, not dependent on trust. Even in a worst-case scenario, investors have a legal claim on the underlying asset through the trustee. 6. What internal controls exist to prevent misuse of investor funds? At GHL India Asset, prevention of fund misuse is ensured through a combination of structural controls, legal restrictions, and process discipline built directly into the investment model. Based on our business system, controls exist at 5 levels. 1. SPV level fund segregation. Each project has a separate SPV with its own bank account. Investor funds are deployed only for that specific project. No pooling or diversion across projects. It prevents cross-utilization of funds. 2. Defined use of funds. Funds are raised only after deal identification and structuring. Capital is used for the property acquisition, the legal clearance and documentation, the project-related execution. It prevents unplanned or unrelated spending. 3. Asset-linked deployment. Funds are tied to a specific identified property. Property is acquired in SPV name post-funding. Security is created against that asset. It prevents the use of funds without asset backing. 4. Debenture trustee oversight. Trustee monitors the security creation, compliance with debenture terms, investor protection mechanisms. It prevents deviation from the agreed structure. 5. Documentation and audit trail. All transactions are legally documented, recorded in SPV books, subject to audit. It prevents opaque or untraceable fund movement. Funds are not just managed, they are structurally controlled. There is a clear audit trail from investor funds to asset acquisition. Nothing is unaccountable. We hope this has addressed your intermediate level understanding of corporate structure. But this is where things get serious. Next week, we move into the advanced level where the core concepts take center stage. What truly happens if an SPV fails, how assets stay protected, and how risks are prevented from spilling across structures. Stay with us, because advanced insights shape advanced decisions.